Welcome to Tech Monetize Official, your trusted companion on the path to financial empowerment. Our mission is to make finance and investing accessible for everyone, especially beginners who may feel overwhelmed by all the jargon and choices out there. Financial literacy is the foundation of lasting wealth. You don't need a finance degree or years of experience to start building your future, just curiosity and the right guidance. We believe that everyone deserves the chance to understand how money works, so you can make informed choices and avoid common pitfalls. That's why we break down complex topics into simple, actionable insights, so you can make smart decisions with confidence, no matter your starting point. The investing world can seem overwhelming, filled with ups and downs, but we're here to guide you every step of the way. From setting your first financial goals to understanding market trends, we're committed to helping you grow your knowledge and your wealth. Whether you're interested in dividend stocks, growth opportunities, or just learning the basics, you'll find valuable resources and practical tips here. If you find our content helpful, consider subscribing to our newsletter for the latest updates, expert insights, and exclusive guides delivered straight to your inbox. Today, we're diving into Ares Capital Corporation, a company known for its notably high dividend yield and unique approach to generating returns. High yields can be tempting for investors seeking passive income, but it's important to ask, are they truly safe and sustainable over the long term? We'll explore what Ares Capital does, how it makes money, and whether its impressive dividend is built to last through changing market conditions. Let's get started and uncover the real story behind Ares Capital's dividend, so you can make informed investment decisions. Join us on this journey to financial freedom and take the next step toward a brighter, more secure financial future. What is Ares Capital Corporation? In short, it's a business development company, or BDC, trading under the ticker ARCC. BDCs act like banks for medium-sized businesses. Too big for small loans, not big enough for Wall Street. Ares Capital provides loans and sometimes invests directly in these companies, fueling their growth. The headline, an 8.5% dividend yield. That means for every $100 invested, you could earn $8.50 in dividends annually, if the payout holds. High yields attract income-focused investors, especially retirees seeking steady cash flow. But a high yield can also signal trouble. Sometimes it's high because the stock price has dropped. That's why it's crucial to look beyond the yield and examine the company's fundamentals. Is Ares Capital's high yield a golden opportunity or a warning sign? Let's dig deeper to find out. To judge the safety of Ares Capital's dividend, we first need to understand how its business model works and what drives its income. This helps us see why its payouts can be so attractive to investors. Ares Capital acts as a specialty lender, providing loans to established middle-market companies that are often too large for small banks, but not quite big enough for major Wall Street financing. These are businesses you might not hear about every day, but they form the backbone of the economy. The company earns most of its income from interest payments on these loans. Because these loans are riskier than those made to giant corporations, Ares Capital can charge higher interest rates, often well above what traditional banks offer. In addition to lending, Ares Capital sometimes takes small equity stakes in the companies it supports. If these businesses grow or are sold at a profit, Ares Capital can benefit from capital gains, adding another layer to its income. The company's profit, called net investment income, comes from the difference between what it earns from its investments and what it pays out in interest to borrow money itself. Managing this spread is crucial for its success. Diversification is a key part of the strategy. Ares Capital invests across hundreds of companies in a wide range of industries, from healthcare to technology to manufacturing, which helps reduce the risk of any single company's troubles hurting the whole portfolio. If a few companies struggle or even default, the impact on Ares Capital's overall results is limited, thanks to this broad and carefully managed portfolio. This steady stream of interest income, combined with occasional capital gains from successful investments, is what funds Ares Capital's generous dividend payments to shareholders. Careful risk management and ongoing diversification are the engines that keep Ares Capital's payouts reliable, even when markets get rocky. By sticking to this disciplined approach, Aries Capital aims to keep dividends flowing to investors year after year. Dividends are a company's way of sharing profits with shareholders, a direct reward for owning stock. For investors, dividends provide real spendable cash, regardless of stock price swings. Reinvesting dividends can compound your returns over time, accelerating wealth growth. Companies that pay regular dividends are often seen as stable and disciplined. BDCs like Aries Capital are required by law to distribute at least 90% of their taxable income as dividends. This structure makes BDCs powerful income generators. But if income drops, dividends may be cut. Unlike fast-growing tech firms, BDCs focus on steady payouts rather than reinvesting all profits. That's why income investors are drawn to them. Aries Capital's legal structure and business model are designed to deliver high regular dividends. But sustainability depends on consistent profits. Can Aries Capital really afford its impressive 8.5% dividend? And is that payout as secure as it seems? For income-focused investors, this is a crucial question. After all, a high yield is only attractive if it's sustainable. Let's dig into the numbers and see what's really going on under the hood. The key metric to watch is net investment income, or NII. This figure represents the core earnings Aries Capital generates from its lending activities, after subtracting all expenses. It's the lifeblood of the company's ability to pay dividends. For a dividend to be considered safe, NII per share should at least match, if not exceed, the dividend paid to shareholders. This ensures the company isn't dipping into reserves or taking on debt just to maintain payouts. Recent financial reports show that Aries Capital's NIO not only covers its dividend, but often does so with a comfortable surplus. This extra cushion is a positive sign for investors. This healthy payout ratio means the company isn't overextending itself or risking its financial stability just to keep shareholders happy. Aries Capital also keeps a close eye on the quality of its loans. Its non-accrual rate, the percentage of loans that are in trouble, remains low, which is a strong indicator of prudent risk management. A diversified, well-managed loan portfolio helps protect the company's income stream, even if a few borrowers default. This diversification is key to weathering unexpected challenges. The company's balance sheet is strong, with manageable levels of debt and an investment-grade credit rating from major agencies. This financial foundation gives Aries Capital flexibility and resilience. Thanks to this financial strength, Aries Capital is well-positioned to weather economic storms and continue paying dividends, even during periods of market volatility. In short, the numbers strongly support the sustainability of Aries Capital's dividend. At least for now, the payout looks solid and reliable. But as with any investment, it's important to consider what could go wrong and keep an eye on potential risks ahead. No investment is risk-free, and Aries Capital faces real challenges. A recession could hurt its borrowers, leading to more loan defaults and less income for dividends. Interest rate changes matter too. If rates fall sharply, Aries Capital's income from floating rate loans could drop. Competition is fierce. More lenders chasing the same deals can squeeze profits. Regulatory changes could also impact BDCs, altering leverage limits or tax rules. While Aries Capital is the biggest player in its space, it's not immune to these pressures. The company's success depends on disciplined lending and a stable economic environment. Investors should be aware that high yields come with higher risks. Even a well-managed BDC can face tough times if the economy turns. Understanding these risks is key before investing for income. So, is the dividend as safe as it seems? Despite the risks, several factors support Aries Capital's dividend stability. As the largest BDC, Aries Capital has scale, resources, and access to top deals. Its focus on senior secured loans means it's first in line to be repaid if a borrower defaults. The company's conservative approach has kept loan losses low, even in tough times. Recent higher interest rates have boosted its earnings, allowing for both regular and special dividends. Management's experience and significant personal investment in the company align their interests with shareholders. Aries Capital's track record through multiple economic cycles inspires confidence. The company has built a cushion of undistributed income, adding extra protection. Strong leadership and prudent risk management are key assets. These strengths make the dividend more resilient than most high-yield options. So, is Ares Capital's 8.5% dividend sustainable? The evidence points to yes, for now. Its core earnings consistently cover the dividend, and its conservative lending approach manages risk well. The company's diversified portfolio and low loan losses add further confidence. While a severe recession or sharp rate cuts could pressure the payout, Ares Capital is better positioned than most. No dividend is ever guaranteed, but this one looks solid compared to many high-yield peers. For income-focused investors comfortable with BDC risks, Ares Capital is a compelling choice. The dividend appears well covered and likely to remain stable unless the economic environment deteriorates dramatically. It's a strong option for those seeking reliable income. We hope this breakdown of Ares Capital's dividend has helped you understand the risks and rewards. At Tech Monetize Official, our goal is to empower you with clear, unbiased analysis. If you found this valuable, subscribe to our free newsletter for more insights and updates. You'll get the latest articles and investment ideas delivered straight to your inbox. Follow us on social media for quick tips and to connect with fellow investors. Building financial knowledge is a journey. Let's take it together. Thanks for joining us today. Stay informed, invest wisely, and we'll see you next time. Your path to financial freedom starts here.